If you watched our most recent market update, you've probably noticed that the number of withdrawn listings are increasing. Resetting the days on market is not going to magically make the house more appealing or show any better. Are sellers giving up? I've found more listings that are listed for sale and for rent at the same time. Or is there something bigger at play here? Welcome to Invest with Jim, where you'll find real estate insights that no one else is sharing. And today we're digging into a recent spike of withdrawn listings in our market. What it means if you're trying to sell, what investors are doing right now, and how it can impact you, even if you're just watching from home. Let's dive in. If you watched our most recent market update, 170 listings have been withdrawn from the market. Out of those, 127 of those came right back on the market. You might be wondering why pull listings and then put them right back up. It comes down to days on market. See, some agents think they're being slick by doing this. Say a property's been listed for months, no action, they remove the listing and they put it right back on the market to try to reset those days on market back to zero, and trying to hide the fact of how long the house has actually been sitting on the market. Because let's face it, if you're a buyer and you see a house that's on the market for like 4 months, are you gonna give them anywhere near list price? Probably not. If I was your agent, I would say they're probably desperate to get an offer. Let's try a low offer and let's see if we can get it, but within reason. But here's the reality. Buyers are actually smarter than that. If they see a house that they like, there's so much information on the internet right now where they can find the old listing, they can see how long it's been on the market, they'll see that it was withdrawn and then put right back on the market. This is not hard stuff to find, but if you have a hard time finding it, work with an experienced agent like myself. Resetting the days on market is not going to magically make the house more appealing or show any better, and especially if it's overpriced, it's still overpriced. So if you're going to try this strategy, you better be coming back to the market with a home that's priced within market range, or just in a more realistic range. Let's just say that. Another interesting thing is I've found more listings that are listed for sale and for rent at the same time. So out of the 2,300 homes that are listed for rent right now, 170 of those are also on the market for sale at the same time. So why would sellers do this? Especially investors like you. Investors are in a tricky spot. Many would like to cash out and sell right now, but only if they can get close to their target number. If not, they're content to hold on to the property and keep collecting rent. They're essentially testing it. This tells me something big. Investors are concerned where the market is heading right now. They do not want to lose equity, but most of them have a long-term mindset. Let's look at why. If an investor bought a home around $500,000, and if they're worried that the market might go down, say 5–10%, you're looking at $25,000 to $50,000 of equity that's going to be gone. But if that same home rents for say $2,000 a month, that's $24,000 in rents that you'll collect annually, which will offset the temporary pain of a declining market. But there's another layer here. A lot of investors picked up their properties during our last recession between 2009 and 2012, we'll say. Those homes are hitting around 15 years of ownership now. This is a prime time for costly updates. This could be the roof, flooring, paint, countertops, cabinets, you name it. If you are an investor that is facing major capital improvements, you might be thinking, should I just sell this property rather than dumping money into repairs? That leads to some very important financial questions. How much equity have you built? What would your tax liability be if you sold? Exactly how much are these repairs? And the most critical question, if you were to sell now, can you reinvest that money to somewhere else where you're making a acceptable return on your investment? For example, if you bought a home for, let's just say $200K, now it's worth $400K. If you were to sell this property outright without doing a 1031 exchange, you're looking around $200K in capital gains, which at 20%, you're looking around $40,000 in tax liability. So you'd be walking away with roughly $360K. Now, can you confidently invest that $360K elsewhere for at least say a 5% return? It's doable, but consider this carefully. Real estate offers very unique tax benefits, appreciation potential, and steady income. Or maybe you consider selling at a slight discount and using a 1031 exchange to buy something newer, needing less repairs, or maybe even a better location, while deferring your taxes on that sale of that property. If you want to check out more information about a 1031 exchange, here's a video right here to tell you more about it. If you're an investor and you're facing this situation and you're thinking about cashing out, reach out to me and I'll help you review your equity, possible tax implications, and options to do a 1031 exchange. The big takeaway here is clarity. Investors are carefully testing the market because they're cautious to lose equity, but confident enough to hold long term. So investors sellers pulling their listings off the market for sale are not necessarily giving up, they're recalibrating their strategy. And buyers are paying close attention, and they are not being fooled by these quick days on market resets or little minor price tweaks. If you're on any side of this equation, the key right now is strategic thinking, not impulsive or knee-jerk reactions. If you found this helpful, please like, subscribe, and share. If you're considering buying, selling, or investing, reach out directly. I'd love to talk through your goals with you. Thank you for watching, and I'll see you on the next one.